Hey traders and investors, it's Serge Berger here. Today I want to talk about whether to use trailing stops or hard stops. I get a lot of questions on this almost every time I give a presentation. I just yesterday gave a presentation again, and that's a question that came up right off the bat when we started talking about stocks. The short answer is it really depends. A lot of things in the markets really depend on the environment, on the stock, or on the asset class itself. So it really depends on what you're talking about. I'm going to be very straightforward on this because really there's not that much to it, but it's an extremely important concept to understand. So if we're looking at something like the SOX, which is the semiconductor index, or one of the semiconductor indices, you can see at the moment this thing is trending like crazy, particularly here over the past few weeks. Has been trending very clearly as it began to break out of a very nice and fairly tight pattern. So you have a breakout and more importantly a breakout in a very trending stock. So that is a situation where using a trailing stop works very well. Okay, why? Well, because it's trending and it broke out, so you have a pretty good probability of the stock continuing the trend. On the other hand, let's say you have a stock like Goldman Sachs, okay, which all things considered here over the past, really pretty much basically since last summer, if you discount or take out the sort of October through January part, has been extremely choppy. So using a trailing stop here, a lot of times would have gotten most people that are sort of in the multiple day to several weeks sort of time frame, gotten stopped out of their trades and frustrated them. So understand the volatility or the directionality or lack thereof of the stock or whatever the asset is you're trading, because it really depends on that. Having said that, going back to the SOX, and this is also very important, and this is really how I use trailing stops. I always start with a hard stop, okay? Because you don't know what the position's doing. So in this case, the SOX broke out. Let's say you would have bought the SOX through some sort of way. Maybe you would have bought it through, let's say, the SMH, which is the semiconductor ETF. Let's use this because it's more practical. You can trade this actually. So let's say on this day here in May, it broke out and you bought it. Okay, so in my case, I certainly would have put a stop. In this case, probably somewhere below the 50-day moving average, which is this yellow line. But once the stock really started trending, which basically was in this case was very luckily confirmed the very next day, I would have started using a trailing stop. How much of what is the distance of the trailing stop? In other words, how much lagging should the trailing stop be? That, unfortunately, is a question I cannot answer for you. That's a question that depends on your own risk parameters and time frames. However, I will caution against using them too tightly, because a lot of the time when a stock is trending, it can still have intraday swings that are oftentimes more volatile than is perceived by just looking at the daily charts. So I hope this made sense, guys. As always, if you've got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader. Take care.